Kilimanjaro PLC prepare its account to 31st December each year. Is considering investing in a computer-controlled production facility on 1st January 2016 at a cost of 50 million naira. That's the initial outlay. This will enable Kilimanjaro PLC to produce a new product, which it expects to be able to sell for 4 years. So that means useful life is 4 years. At the end of this time, it has been agreed to sell the new production facility for 1 million naira. So that represents the scrap value. Sales of the product during the year ended 31st December 2016, and the next 3 years are expected to be as follows. Okay, that's the sales units. Selling price, units variable costs, and fixed overhead costs, excluding depreciation, are expected to be as follows during the year ended 31st December 2016. Two things I want to point out in that particular statement. Examiner has told you that your fixed overheads excluded depreciation. You recall when I was explaining relevant cash flow to you, I mentioned that there are 3 ways examiner can test fixed costs. I said that if you are given fixed cost without additional information, that fixed cost is irrelevant. Again, examiner can give you fixed cost including depreciation. That fixed cost is also not relevant, but you are supposed to calculate annual depreciation and less from the fixed cost. The difference is relevant. Then 3, if you are given fixed cost excluding depreciation, then it means that the fixed cost is relevant. So what that simply means is that all the fixed costs that have been given in this question, they are relevant. They are relevant fixed costs. So you have to consider it. The second point that I want to point out is that examiner has given you first year price because all the figures that you have here are on the basis of 31st December 2016. And 2016 is the first year. So you have been given first year price. So what that means is that you need to start inflating from year 2. So watch out. The following rates of annual inflation are expected for each of the years during 2017 and 2019. See, examiner has also buttressed my point by telling you that, okay, these inflation rates will apply for 2017 through 2019. That means 2016 will not be affected, which of course, 2016 is the first year price. Move on. The company pays taxation on its profit at the rate of 30%, okay? With half of this being payable in the year in which the profit is earned, and the remainder being payable in the following year. So what that means is that from the taxable profits, after you have applied 30% on the taxable profits, you are going to pay 50% in the current year, then the balance of 50% will be paid in the following year. Investment of this type qualify for tax depreciation rates. Tax depreciation at the rate of 25% per annum on a reducing balance basis. So tax depreciation is the same thing as capital allowance, and we are told that it's 25%, okay, on reducing balance basis. The board of directors of Kilimanjaro PLC has agreed to use 12% post-tax discount rate. So the cost of capital is given as 12% to evaluate the investment. So number A, advise Kilimanjaro PLC whether the investment is financially worthwhile. That is, you should calculate NPV. B, calculate the internal rate of return. C, define the following terms. All right, so that's the question. So we want to calculate NPV based on the information available. So I will stop sharing this question, then I'll move to the working notes. All right, so we want to calculate NPV. What are you supposed to do? First thing first, as you can see in this question, examiner has given us selling price. Okay, we have been given selling price to be 1,200 naira per unit. So all I need to do is to go back to the question, in case I'm given inflation rate. Yes, I'm given inflation rate of 5%. In that case, I will inflate this 1,200 is the first year price. So I will not inflate the year one price. So I will then move to year two. In that year two, I will just multiply this 1,200 by 1.05. I will get the inflation for the inflated selling price for year two. I will continue to inflate like that until I get to 2019. Once I have that done, once I've inflated the selling price, I will then multiply with number of units sold. Examiner has given to us the units. Okay, we have been given the units for the respective years. So just multiply the selling price with the units sold. That will give us the total sales. Once I have the total sales, I will go and post it. Then I will go back again. I will check from the question if I'm given variable cost. Yes, there is a variable cost of 750. This variable cost, any inflation? Yes, there's inflation because variable cost is under production cost, which is 8% inflation. So I will inflate the 750 by inflation rate of 8%. I will do for the remaining years. I will multiply with number of units produced. All right. Once I have that done, I will go and post. So that's how you are going to be. That's how you are going to do for all of them until you are done with all the requirements. Okay. So quickly, let me stop sharing this and move to the working notes. Okay. So the name of this company is Kilimanjaro Solution to illustration. What illustration is that? That's illustration number 6. Page, that's page 80. Page 80. Okay. So I will then say Kilimanjaro PLC requirement number A. So in that requirement number A, examiner wants us to calculate, you have to advise whether the investment is financially viable. And I've told you, whenever you are asked to evaluate, advise, assess the financial viability, what the examiner wants you to do is to calculate the net present value. So in this case, I want to calculate net present value. I would then say calculating net present value. Okay. Let's say our figures are in thousands. Let's put our figures in thousands. So the useful life of this project is 4 years. Because of tax, we are told that 50% of the tax liability will be paid in the current year. The balance of 50% will be paid in the following year. So the balance of 50% of the tax in year 4 will be paid in year 5. Therefore, this will extend to year 5. So I would then say year 0, 1, 2, 3, 4, then year 5. Create a column for working. Okay, so the first item, based on the format I gave to you, is the sales value. Therefore, I will then go back to the question. This will be for NPV calculation, internal rate of return, the assumptions. Then, if you like, we can do, let's start our working from here so that we don't go too far. Working. Yes. Yes, 1, 2, 3, then 4. Units. Please give me the unit as given in the question.
100 for year 1.
100
105.
100, 105, yeah,
110.
okay, and then
108.
108. The unit, I guess they're in thousands, right?
Yes, sir.
Okay, so in this case, let's say this is A. Now, working number one, I want to determine sales value. To get my sales value, I need to first of all determine my selling price. Therefore, selling price, inflation, what's the inflation rate on selling price? What's inflation rate? Please, you have to respond quickly.
5%.
5%. Then also, the first year price is 1,200. The first selling price is 1,200 for 2016. Therefore, to inflate this, you bring out your calculator. We want to inflate the 1,200 for the second year up to year 4. I would then say 1,200 multiplied by 1.05 equal, that's 1,260. 1,260. 1,260 multiplied by 1.05 multiplied by 1.05, that's 1323. 1323 multiplied by 1.05.
1389.
1389. With this, we have inflated the selling price. You will notice that year one still remain the same. That's your first year price, 1,200. So that's what I was saying, that we don't inflate the base year price. So because it is that base year price we are going to use to inflate for the remaining years. All right. So with this, I then determine my sales value. Sales value in thousands. So let's say this is B. Therefore, sales will be equal to A times B. Give it to me. Multiply A with B.
120,000 for year one.
120,000. Next.
Second one,
132,300.
132,300.
This third one, 145, 530.
145, 530.
530. The fourth one, 150.
150,012.
012. So with this, we have calculated our sales value. We then go and post. 120 is the first year sales. I will then come here, 120,000. The second year is 145.
132,300.
Okay. 132,300. 132. 132,300. Then year 3.
145,530.
530. Year 4.
150,012.
012. So with this, I would then say year 1, working number 1. The next item will then be variable costs. Variable cost. Please, on the day of your exam, you have to write it out in full. Variable cost. So let's go and do working for that. Working number 2. Variable costs. All right. So to get the variable costs, I will pick the variable cost for year 1, which is 750. Inflation rates, production cost. Inflation rate for production cost is 8%, right?
Yes, 8%.
So to now get the variable cost per unit for year 2, you are going to multiply 1.08 multiplied by 750. What do you have?
810.
Multiply by 1.08.
850.5.
850 point, that's 851. What you have in your calculator multiplied by 1.08?
893.
893. So that's that. Then let's say this is C. Therefore, total variable cost in thousands will then be equal to A times C. Give it to me.
Hello, sir.
Yes,
Hello, sir. The third year is 875, not 851.
874.
874.8. Yes, so I approximated it to 875.
Okay, let me see. I have 750 multiplied by 1.08 equal 810 multiplied by 1.08 equal 875. Okay, this one is 875.
Okay, what do you say?
Then multiply by
Eh?
1.08. That's 945. Error. This 945. You have to be very careful. Very, very careful. So let's multiply with the number of units. Year one is 75,000. Then year two is what?
Year two is 8505. 85050.
85,050.
The third one, 96,250.
96,
1,250.
250. Year four.
102,060.
102,060.
Yes,
Okay,
sir.
so let's post 75,000 for year one. Here is 75,000. It's a cash outflow, variable cost. The second one is 85,050. The third year variable cost is what? That's 96,250. Here is 96,250. 102. 102 and 60. That's for year five. That's working two. Then I will go back to the question. After variable cost, what's the next cash flow? We also have variable selling and distribution cost per unit. So let's go and do working for that. It's relevant. Variable selling expenses is relevant. Number three. Variable selling and distribution expenses. If you don't incur the cost, you won't be able to make sales. Okay, so variable selling and distribution. What's the inflation rate for selling expenses?
6%.
At 6%. So
Yes.
selling expenses for year one is 100. Therefore, 106 multiplied by 100. What do you have? That's 106. 1.06 multiplied by 100 will give us 106. 106 multiplied by 1.06. What do you have?
112.36.
112. So what you have in your calculator multiplied by 1.06? Give it to me.
119.
119. So that's inflated selling, variable selling expenses. Let's say this is D. Then to now get the total variable selling and distribution, figures in thousands. This will then be A multiplied by D.
Yes.
The first one will be 10,000. Then 106 multiplied by 105. What do you have?
11,130.
11,130 or 120?
130. 130.
130. Okay. The next one, 112 multiplied by 110.
12,320. 320.
12,320. And the last one, 108 multiplied by 119.
12,852.
12,852.
52. Yeah.
So let's go and post 10,000, 11,130. Variable selling and distribution. 10,000 for the first year. It's a cash outflow. You are spending it. The second year is 11,000. Is it 130? Yeah. Then the third year is 12,320. 12,320. Then 12,850. Is it 850 or 852?
52.
852. Okay. So that's working number 3. I will then go back to the question. What other expenses, what other relevant cash flow do we have in the question? We also have fixed production cost for the year, which is 4 million naira. Because this one does not relate to number of units, I don't need to do working for it. So fixed production cost is 4 million naira, and the inflation rate for production cost is 8%. Therefore, I will then say fixed production cost at 8%. For the first year price is 4 million. To Sorry, 1.08 multiplied by 4,000.
4,320, sir.
4,320. Multiplied by 1.08.
4,666.
4,666.
Yes.
Multiplied by 1.08.
5,039.
5,039. So that's that. The next item is we also have fixed selling and distribution expenses cost for the year, 2 million naira. Selling expenses inflation rate is 6%. So 2 million fixed selling and distribution at 6%. So no working because it doesn't relate to units. The first year price is 2,000. 2,000 multiplied by 1.06. What do you have?
2,160.
2,160 multiplied by 1.06.
2,290.
That is 2,120.
Which
Year
one?
2. Year 2.
2,120.
Yes, sir.
Okay, that's different from the first one. So 2,000, let me confirm that first.
Yes, she's correct.
2,000 multiplied by 1.06 equal, that's 2,120. Okay. 2,120 multiplied by 1.06.
2,247.
247. 2247.
Yes.
Okay. Then multiply by 1.06.
2,382.
2382. So that's that. Then the next one, after fixed selling and distribution expenses, we also have fixed admin expenses, which is 1 million naira. And then inflation rate for administration cost is 5%. So 1 million fixed admin at 5% inflation. The first year price is 1 million. Multiply by 1.05, that's 1,050. Then multiply by 1.05. What do you have? 11
102, 103, 03.
1103.
Yes, sir.
Multiply by 1.05.
1158.
1158. So that's it. So there's no other cost again. Let me check. I think that's it. We have covered all the relevant cash flows in the question. So at this point, the next thing we need to do is to determine taxable profits. So let's determine taxable profit. So add up everything. Okay. So this is profits. You know, we have a format. Year zero is dash. So please pick it one by one so that we can, to be faster.
The first
Year
one
one is 28.
28,000.
Yes, sir.
Year two, yeah.
The fourth year is 26,520.
Which one?
The fourth year,
Okay, 20 what?
26,520.
26,521.
Yes, sir.
Second year, 28,630.
28,630. Then year four.
So the third year is 28,944.
944. Okay, so that's the taxable profit. Ordinarily, what I'm supposed to do is to just go ahead and multiply tax rates on the taxable profit. But in this case, examiner has told you that when you are determining your tax, 30% company tax rate is your tax liability. However, 50% will be paid in the current year and the balance of 50% will be paid 1 year after. So in this case, we need to go and do working for our tax liability because of that condition that 50% should be paid now and 50% later, because we can't do it under this table. So we have to go and do the working for it. So working number 4. I want first thing first, before you calculate your tax liability, you must compute your capital allowance. I would then say calculate tax saved. So in our own case, we are going to use capital allowance to reduce tax liability. When you go to, I think in the ebook, in the PDF that that some of you have, I use tax saved to reduce the tax liability. But in this one, I'm going to use capital allowance. So if you have access to the two, so you'll be able to, anyone that is more convenient, you do it. So because of time, I won't be able to demonstrate the two. All right, so let's calculate capital allowance. So I would then say calculating. So because like I explained to you last time, the essence of capital allowance is to reduce tax liability. So before you calculate your tax liability, you have to adjust for capital allowance. So in this case, to get my capital allowance, you have a format already. Create a column for year, narration, then the cost. If I want to use tax saved, then I will create additional column for tax saved on capital allowance. So I don't want to use follow that route. Figures are in thousands. In year 0, the cost of the facility, according to the question, we are told is 50 million naira. Okay. The cost of the facility on 1st January 2016 is 50 million naira. So I would then say 50 million, figures are in thousands. And we are told that capital allowance is on a reducing balance basis. So in year 1, we are going to calculate. In this question, the examiner did not give us initial allowance. We don't have initial allowance. That means you only compute for annual allowance. So I would then say annual allowance at 25%. The straight line tax depreciation, the tax depreciation allowance given is 25%. Therefore, what's 25% on 50,000?
12,500.
12,500 minus 50,000 will give us 37,500.
500.
So that's the tax written down value at the end of year 1. I will then move to year 2. Annual allowance at 25% of 37,500. What you get?
9375.
93. Did you say 9375?
Yes,
Yes, sir.
9375.
Yes,
Yes.
Okay. 9375 minus 37,500.
28,125.
28,125. That's the written down value at the end of year 2. I will then move to year 3. Capital allowance at 25% of 28,125.
7031. 7031.
7031. Okay. Minus 28,125. That's 20. Or yes, 20.
2194.
21. Did you say 21?
Yes, 21094.
21094. So this written down value at the end of year 3. You know, this facility has 4 years life. So in the final year, you are going to compare the tax written down value with the sales proceed. So I would then come here. Year 4 is the final year. Therefore, in that year 4, I would then compare the sales proceed. All right, scrap value. We are told that the facility will be disposed of at 1 million naira. So I will then less 1 million. Figures are in thousands. The difference of 20,094 represent balancing allowance. This is balancing allowance. So that's the final year, year 4. Okay. So that is that. If I want to use tax saved on capital allowance to reduce my tax liability, I will create additional column here. So this will then be the tax saved. Tax saved at the company tax rate of 30%. I would then say, what's 30% of 12,500? Let me just put it there. 30% of
3750.
3750. What's 30% of 9375? 9375. 30%.
2813.
Okay. 30% of 7031.
2109.
All right. And then 30% of 20,094.
6028.
6028. So add up everything. What do you have? Add up 3750, 2813, 2109, then 6028. Add it up. What's the total? Because you cannot claim more than the capital allowance you are supposed to claim. So this will then represent total tax saved.
That's 14,700.
14,700. So total tax saved. So to now confirm that you have not claimed more than what you are supposed to claim, then you can use this calculator. I'm sorry, this is a formula. Total tax saved equal to the cost of the assets minus the scrap value multiplied by company tax rates. Company tax rates. So in this case, the cost of the facility is 50,000. Scrap value is 1,000. Company tax rate is 30%. So you should have the same figure as 14,700. So with this, you can then confirm that you have not overclaimed your capital allowance. You have not over or underclaimed capital allowance. All right. So if that is the case, now that you have computed the capital allowance, you can then proceed to calculating the tax liability. So that will be working number 5, tax liability. Calculating tax liability. So in our own case, we are using capital allowance to reduce tax liability. So if that is the case, we create a column for year 1, year 2, year 3, year 4, year 5. Let me give a space. Year 2, 3, 4, then year 5 for tax purposes. So before you calculate your tax liability, first thing first, if you are using capital allowance to reduce your tax liability, the first item where will be the profits. For profit for the first year is 28,000. The following year, the second year, what's the profit for the second year?
28,000.
28,630.
Yes.
28,630. Then year 3 taxable profits.
28,000.
28,000 what?
944.
944. Then year 4.
26,000.
26,000 what?
521. 521.
521. So this is the profit. So before you pay your tax liability, you need to first of all adjust for capital allowance. So you deduct capital allowance. So capital allowance we computed for year 1 is 12,500. So you less 12,500 because don't forget the essence of capital allowance is to reduce tax liability. Capital allowance for year 2, 9,375. Capital allowance for year 3 is
703.
7031. Capital allowance for year 4 is 20094. That's the capital allowance for year 4, 20094. With this, let's give me the difference.
15,500 for year 1.
6,000, did you say 15,000?
Yes, 15,500.
16, okay, 15,500. Yes, year 2.
19,255.
19,255.
55.
All right.
The fourth one, 6,427.
6,427. Year 3,
21,900.
913.
So this represents the taxable profits. So it is on these taxable profits, you are going to apply the company tax rate of 30%. All right. So you then say tax liability at 30%. So what's 30% of the first year profits?
Was 4,650.
Pardon?
4,650.
4,650. The second year?
5,777.
5,777.
The fourth year, 19,1928.
1,928.
6,574.
6,574.
The
So
third
that's,
year, okay,
yeah, so that's the tax liability. Ordinarily, this is what you are supposed to go and post. But the examiner has told you that 50% of this will be paid in the current year, while the balance of 50% will be paid in the following year. Therefore, I would then say the first 50%. So what's 50% of 4,650?
2,325.
2,3. Here is 2,325. So in the second year, we pay the balance of 2,325. Again, what's 50% of 577? 577.
2,889.
2,889. You know, you approximated. So the balance will then be, 2,888. So by the time you add the two, it won't be more than 577. All right. So the next one, 50% of 6,574.
3,287.
3,287.
3,287. Then the balance of 3,287 will be paid in the following year. Then 50% of 1928.
964.
964. Balance will be paid in the following year. 964. So let's get the total. Let's add it up. That will be the tax liability you are going to post. Here is 964. Here is 2,325. Yes. Here will be 5,214. Here will be 6,175. Please confirm.
25, yeah.
The fourth one is 4,251.
4,251. So we then go and post 2,325. Tax liability 2,325. So here will be 2,325. What's the second year?
5,214.
5,214. Year 3.
6,175.
6,175. Year 4.
4,251.
4,251. Then year 5. 9. What's year? 964. So this is working number 6, I think. Let me confirm. That should be working number 6. 5. Okay, working number 5. All right. So that's that. Because we are using capital allowance to reduce tax liability, so there's no need for you to come and write tax saved on capital allowance again. You know, you have a format. Tax liability. So there's no need for you to come and write tax saved on capital allowance. So this is working number 5. So after tax liability, you consider scrap value. The scrap value of the facility we are told is 1 million naira. This 1 million naira, of course, is in year 4. Please, you have to be very careful in this case. The tax written down value, sorry, the scrap value is in year 4. Year 4 is the final year of the assets. So year 5 is because of tax. That's why you have year 5. So you have to be very careful so that you don't give scrap value to year 5 instead of year 4. So watch out. Then after scrap value, you consider initial outlay. The initial outlay of the asset of the facility is 50 million. It's a cash outflow. Then, if in the question you have working capital, you consider it. But in this question, we don't have working capital. Therefore, let's get the net cash flow. Here is 50,000. Here, give me the answer.
25,675.
964. Which one?
The first year.
25.
675.
675. Okay.
23,416.
23,416. Year 3.
Year 3.
22,769.
769. And then year 4.
23,270.
23,270. Okay, so this represents the net cash flow. So after the net cash flow, with this net cash flow, you can calculate and you can use any technique to evaluate the project. You can use NPV, you can use internal rate of return. In fact, you can use payback period to calculate your to appraise, to evaluate the project. All right. So in this case, after this, I would then say discount factor because we are calculating NPV. What's the... Yes?
Year 4, I'm getting 23. Oh, okay, it's 270. Sorry, I didn't see the handwriting there. It's correct.
All right. So what's the cost of capital given in the question? 12%, right? Cost of capital is 12%. So I would then say at 12%, you have inflated the, you have converted real cash flow to money cash flow. That's why you inflated it. So this 12%, you can see examiner is silent. You are not told whether it is money cost of capital or real cost of capital. Where examiner is silent, then it means it is money cost of capital. Okay? So in this case, I need you to give me discount factor for year 1 at 12%. 1.12 raised to power -1 for year 1. That's 0. What? Yes.
0.8929.
893. 1.12 raised to power -2. Year 2. Yes.
0.797.
0.797.
Then 0.712. Year 4. 0.6 what?
0.636.
63.
Then year 5.
0.527.
527. So give me the present value. Multiply to get the present value.
$22,928 for year 1. 22,928.
928.
The second one, 18663.
663. Year 3.
16,212.
16212.
The next one, 14,800. 14,800.
800, okay. Yeah, 5.
508, bracket 508.
508. So to now get the NPV, you add up the positive present value. Add up the positive present value, then less the negative. What's the final answer? 22928 plus 18663 plus 16212 plus 14800 equal minus 50,000 minus 508 equal 22 what?
22095.
095 positive. So examiner is now asking you, you have been asked to advise Kilimanjaro PSC whether the investment is financially worthwhile. Because our NPV is positive, I will then say the investment is financially worthwhile, considering the positive net present value of 22,095,000 naira. Therefore, the investment should be accepted or should be undertaken. So that's that. So we have answered requirement number A, which is 17 mark. You can never end the 17 mark if you don't state your assumptions. All right, whatever the assumptions you have made in the question, I've already told you there are some specific assumptions. So you then say before that, say assumptions. Don't start it, go. Assumption. So you then say the calculation above is based on the following underlying assumptions. So number one, you need to first thing first, whether you are in the question, you have to talk about cash flow. What do you mean by cash flow? You then say it is assumed that the cash flow estimates, all those cash flow given to you in the question, like selling price, the variable cost, the selling expenses, all those cash flows, that's the cash flow estimates, are realistic and will occur at the end of each year. So this is a given. In the question, once you are, there certainly you are going to have cash flow. So you need to talk about it. And this is what you are expected to say. Number two, in the question, we also have inflation. We talk about inflation. You are given different inflation rates. You then say, it is assumed that the inflation rates, the specific inflation rates will remain constant. Will remain constant within the period under consideration. Okay. So it is assumed that the inflation rate will not change. So number 3, you can talk about cost of capital. So examiner has given us cost of capital of 12%. We then say the cost of capital of 12% is assumed that the cost of capital of 12% is assumed to be appropriate okay, and consistent, to be appropriate and consistent with the cash flow. Okay, so you have inflated the real cash flow given to you, you converted it to money cash flow. Therefore, the 12% cost of capital is also money cost of capital, which is consistent because you have to use money cost of capital for money cash flow, real cost of capital for real cash flow. So any other assumption that you have made in the question, you indicate it. In this particular question, there is no other one again. All right. Except that we want to talk about the fixed costs, okay? We can also talk about the annual fixed costs, that they will remain constant within the relevant range, all right? So our assumption is that the fixed costs will not increase because once the fixed costs increase, that will also affect our assumption, our decision to accept the projects, okay? So like I said, if you like, you can talk about fixed costs. If you like, you can just stop here. So that's it. So if in the question you are given all those sunk costs, like market survey costs, the development costs, the R&D costs, the feasibility study costs, we are given those ones. You also need to comment on it as your assumption. But in any question on capital budgeting, where you have inflation, then these are the static assumption you must comment on. All right. So then let's go back to the B part of the question. You are not asked to calculate the internal rate of return. Okay. Number B, calculating internal rate of return. Okay. And you know that whenever you want to compute internal rate of return, you are expected to assume 2 discount rates that will produce 2 opposing NPV. One discount rate will give you positive NPV, then another discount rate will give you a negative NPV. Now, before you assume your discount rates, you have to compare the size of your cash inflow relative to the cash outflow. When you look at your net cash flow, all right, when you look at your net cash flow for year 1 up to year 4, when you add it together, you will notice that it's almost, it doubles the cash outflow. So in that case, if you use a lower discount rate, you may just be doing iteration. Because if you assume 5%, 5% will surely give you a positive NPV. If you increase it to 10%, you still get positive NPV. So once you discover that your cash inflow is almost doubled or almost double the cash outflow, then in that case, the discount rate that you are going to assume should be high as possible. So in this particular instance, let's try 30% and see what we are going to get. So I would then say assume 30%. Let's assume 30% and see the results. So create a column for year, cash flow, discount factor, at, then we have present value. Okay, so we are starting from 30%. We want to see if 30% is positive, we increase it. If 30% is negative, you reduce the second discount rate. Okay. All right. So year 0 up to year 5. Year 1, year 2, year 3, year 4. Let me manage here. Then year 5. So net cash flow in year 0 is 50,000. Net cash flow in year 1 is 25,675. Here is 25,675. Then the next cash flow for year 2 is 23,416. 23,416. Net cash flow for year 3 is 22,769. 22,769. Net cash flow for year 4 is 23,270. 23,270. Then year 5 is 590. Is it 5 or 960 something? 964. Net cash, no? Yes, 964. 964 negative. So in this case, you then give me, what's the discount factor at 30% for year 1? Yeah. Are you still there?
15,000.
Discount factor at 30% for year 1.
0.7692.
0.769. Year 2.
0.592.
592. 592. Year 3. 1.3 raised to power minus
5.
4 what?
5.
Okay. So 0.13 raised to power minus 4.
1, 2, 3.
1.3 raised to power minus 4.
0.350.
0.350.
50.
1.3 raised to power minus 5.
0.269.
Okay. So in this case, we need to get the present value. To get the present value, I will then multiply. Here will be 50,000. Then what do you have for year 1?
19,744.
19,744. 744. Year 2.
13,862.
13,862. Year 3.
10,360.
360. Year 4,
8,145.
8145. Year 5,
259.
minus 259. So what's the NPV? 19,744 plus 13,862 plus 10,360 plus 8,145 equal minus 50,000 equal minus 259 equal. Give me what you have.
1,852. 1,852.
1,852. Positive, right?
Yes, positive.
So we assume 30% discount rate and we got a positive NPV. Let's increase by 5%. Let's increase to 35% to get a negative NPV. So here is 35%. So give me discount factor at 35% for year 1.
Hello, sir.
Yes.
I thought since we've already increased it to get the positive one, I thought to get the negative one, we are meant to decrease it.
When you decrease, you'll be having a positive. So you have to increase. To get the negative, you increase it. All right. So for
But
year 1,
to
yes,
get
you
the
want
to increase it, you have to decrease it.
decrease what?
To get a positive MPV, you have to decrease it.
Yes, that's what I said.
But
But
the
in
what
this,
we did, the first one, we increased it to get the positive MPV.
the first one we assume is 30%. 30% produce a positive NPV of 1852. What do you do next to get a negative? You increase your discount rate. That's why we increase to 35%. Do you understand what I'm saying?
Understand now?
Discount factor
0.7
0.741.
1.
Year 2,
0.549.
okay. Year 3,
0.406.
year 4,
0.301.
0.301.
year 5,
0.223.
223. Then let's multiply with the cash flow. You have to be very careful on the day of your exam when you have this kind of a table so that you don't give what belongs to Peter to Paul. You may want to pick the discount factor at 35%. Mistakenly, your eyes can go to discount factor at 30%. You won't know. So you have to be very careful. Therefore, 25,675 multiplied by 0.741. What you get?
19,025.
19,025. Okay. Next one.
12,855.
12,855. Next one.
9244.
9244. Next one.
7004.
7004.
004.
Okay. 964 multiplied by 0.223.
215.
215. All right, negative. So give it to me. Add it up. Add up the positive present value, or the positive present value minus the negative. What do you have there?
Negative 2087.
2087. So we assume 30% produces a positive NPV of 1852. Then we increase to 35%. We got negative 2087. Now that you have gotten positive and negative, we then calculate your internal rate of return. So let's go down there because I don't have space again to let me do this. So after this, so you come down here, straight down. Straight down. Straight down. Straight down. So I want to calculate internal rate of return. So I would then say calculating internal rate of return. The IRR, let me remove this. Esther, well done. So internal rate of return is lower discount rate plus NPV of the lower divided by NPV of the lower plus NPV of the higher discount rate, all multiplied by higher discount rates minus the lower discount rates. So we assume 30% and 35%. 30% is lower, so 30 plus NPV of that 30 is 1852. Is it 1852? Let me confirm. Yes, 1852. NPV of the higher is 2087 over 1852 plus 2087 multiplied by higher discount rate of 35 minus lower discount rate of 30. Final answer, give it to me. You start from the denominator. 1852 plus 2087 equal 1852 divided by answer equal multiply by difference between 35 and 30, which is 5. Then final answer, what do you have? You now had 30%, so that will give you 32 what? What's your final answer? Your final answer? Yes?
I think 32.35.
So approximately it's 32%.
Okay.
So the internal rate of return is approximately 32%. The IRR is approximately 32%. That's it. So the number C part of the question, all these ones are in your notes. You have to define real rate of return. Real rate of return is the cost of capital that does not include the possible effect of inflation. Is a rate of return that is stated in real terms. That's it. The number 2, money rate of return. Money rate of return is a rate of return that incorporates the possible effect of inflation. It's also known as nominal discount rates. All right, that's it. No need to talk too much. It's just 1 mark. Then number D, you have to explain briefly how real rate of return and money rate of return will be applied in the calculation of the net present value of a project's cash flows. Of course, this is just asking you about the general rules which states that money cash flow for in calculating the NPV. To answer this particular requirement number D, to calculate the NPV, the real rate of return will be applied to discount the real cash flow, whereas the money rate of return will be applied to discount the money cash flow. In the calculation above, the rate of return of 12% has been applied to discount the money cash flow. That's all. That's all. Just 3 marks. No need to talk too much. So that's end of the question. At this point, let's spend the remaining minutes to talk about risk and uncertainty. If you are ready, I'm ready. I will stop sharing. Okay. Let me just see. Yeah. Do I need to the working notes? I'm not sure I will need any working notes for now. In any case, let's talk about risk and uncertainty. Yeah, any questions so far before I switch? So if there's no question, let's move on. So we are done with capital budgeting. So let me